Hello and welcome. Today, with a little help from the experts over at My Tax Accountant, we're diving into a topic that can cause a lot of headaches if you're not careful. We're talking about non-coded income. Sounds a bit jargony, I know, but stick with me because understanding this could save you a nasty surprise from HMRC. So, let's kick things off with a question. Have you ever had that moment? You open a letter from the tax office, your eyes scan down to the bottom line, and whoa, the number is way bigger than you thought it would be. It's a horrible feeling, right? It can mess up your budget and leave you totally baffled, asking, how did this even happen?
Well, there's a good chance the culprit is this thing called non-coded income. Don't worry, it's not as scary as it sounds. We're going to break it all down for you piece by piece. We'll look at what it is, how it really affects your wallet, and most importantly, what you can do to stay in control.
All right, so first things first, let's get right to it. What exactly is non-coded income? To get our heads around it, it really helps to think about how tax normally works for most people. Okay, here's the deal. If you're an employee, you're probably on the PAYE system. That's pay as you earn. It's where your employer sorts out your tax before you even get your salary. Your tax code is the instruction that tells them how much tax to take. But non-coded income, well, that's any taxable cash that falls outside of that system. It's money that HMRC doesn't see on your payslip, so the tax isn't taken off automatically. So what kind of money are we really talking about here? I mean, this isn't some rare, obscure thing. With so many people having side hustles and different ways of earning a living these days, it's actually super common. Let's look at some real-world examples you might recognize.
First up, and this is a big one, is the classic side hustle. Let's think about someone like Jane. She's an accountant in London during the week. That's her main gig, all taxed nicely through PAYE. But on the weekends, she does a bit of financial consulting for small businesses. When a client pays her, say 500 quid, that money lands straight in her bank account with no tax taken off. It's so easy to see that as just extra cash and completely forget that the taxman will want a slice of it later on.
And another huge example is rental income. Imagine David. He owns a buy-to-let flat and gets a steady £12,000 a year from his tenants. That rent goes directly to him. HMRC has no way of taking tax off at the source. It's all on David to declare that income. Sure, he can deduct his expenses like maintenance or letting agent fees, but at the end of the day, the responsibility to report that profit is 100% his. And then, of course, there's money from investments. Now, this one can be a little sneaky. We all get tax-free allowances for things like interest on our savings or dividends from shares we own, which is great. But if you're lucky enough to earn more than those allowances, that extra bit on top, well, that often becomes non-coded income you need to tell HMRC about yourself.
Now here's a little pro tip for you. The government gives you something called the trading allowance. It's basically a green light to earn up to £1,000 a year from a side hustle or other bits of casual work, completely tax-free. No need to even tell HMRC. But, and this is so important, the second you earn just £1 over that, say £1,001, you have to declare the entire amount, not just the bit that's over the 1,000.
Okay, so now we know what it is and where it comes from. But the real question is, why does it matter so much? This is where we get to the heart of those surprise tax bills. Let's have a look at the actual impact this can have on your bank balance, because this is where that extra cash can really come back to bite you.
Here we have the income tax bands for the 2025-26 tax year. Now, the absolute key thing to understand is that your non-coded income doesn't get its own little tax calculation. No, it gets stacked right on top of your main salary. It's the cream on the cake, the cherry on top. And that means it's taxed at your highest rate of tax. This is the trap that catches so many people out.
Let's make this crystal clear with an example. Meet Liam. His day job pays him £48,000 a year. He's comfortably in the 20% basic rate tax band. He also made a tidy £5,000 on the side from some freelance work. Awesome. But wait, when you add that together, his total income is £53,000. That pushes him over the higher rate threshold. What does that mean? It means a chunk of that freelance money, nearly £3,000 of it, is suddenly being taxed at 40%, not the 20% he might have assumed. The tax on that extra cash just doubled. That's a massive difference.
So as you can see, you really can't just hope for the best. You've got to be proactive and take control. This next bit is all about the practical stuff, how you report this income, and the deadlines you absolutely cannot afford to miss. Getting organized is your best weapon against the tax shock. Luckily, the process isn't too scary when you break it down. First, if you've earned over that £1,000 allowance, you have to register for self-assessment with HMRC. Step 2, and you've got to be disciplined here, keep good records.
every penny you earn, and every relevant business expense you have. A simple spreadsheet will do. Finally, you pull it all together and file your tax return online. Now listen up, because these dates are set in stone. Pop them in your calendar right now. You have to register by the 5th of October following the end of the tax year. If you're old school and doing a paper return, it's Halloween. But for pretty much everyone else, the big one is January 31st. And that is the deadline to both file your return and pay what you owe. Don't forget that second part. And what happens if you're even one day late? Boom! An instant, automatic 100-pound penalty. No ifs, no buts. It doesn't matter if you don't actually owe any tax, or even if you're due a refund. If the form is late, you get the fine. And believe me, that's just the start. The longer you leave it, the more penalties and interest start to pile up. It's just not worth it. Look, I get it. This can all feel like a bit much, especially if you're juggling a job, a side hustle, and everything else life throws at you. But the great news is, you absolutely do not have to handle this on your own. Before we get to that, though, let's just quickly run through the main things you need to remember.
Okay, a quick fire summary. What are the key takeaways? 1. Track all your income. 2. Know those deadlines. 3. Use those handy £1,000 allowances if you can. 4. Keep amazing records of your expenses. They are your best friend for reducing your tax bill. And 5. The golden rule. Please don't leave it all until the last week of January.
At the end of the day, tax can be complex, and getting it wrong can be stressful and expensive. But trying to muddle through it all by yourself isn't your only choice. For professional, friendly advice that makes sure everything's correct and you're not paying a penny more than you need to, you can always talk to the team that helped put all this information together.
You can get in touch with My Tax Accountant directly. Just send them a message on WhatsApp or give them a call on 7854-255-375. You can also send an email to info@mytaxaccountant.co.uk. They're there to help you sort all this out. And for more great, easy-to-understand tax tips just like this, make sure you subscribe to their YouTube channel. Thanks so much for joining me.